Good evening, folks. So let's get into a couple topics that I'm gonna tie in together. So, consumer sentiment, passive investing, which there has been a conversation about a potential bubble for passive investing, and also the modern economy. All right, so the modern economy isn't driven by fundamentals alone anymore, which we can obviously see. It's driven by psychology, liquidity, asset prices, debt, and automated capital flows, and all of them feed into each other. Most people look at consumer sentiment, the stock market, inflation, passive investing, and spending as separate topics. They're not. They're all a part of the same feedback loop. Consumer sentiment is really psychological economics. Consumer sentiment measures how people feel about their finances, inflation, jobs, debt, and the economy overall. The key thing most people miss, economies are heavily behavior driven. If consumers feel financially unsafe, they spend less, borrow less, invest less, and become defensive. That behavior alone can slow economic growth, which means perception itself becomes an economic force. Why sentiment feels worse than official data? This is where today's economy becomes interesting. The government's hard data may show low unemployment, GDP growth, strong spending, and rising markets. But consumers may still feel poorer, financially squeezed, and economically stressed. Why? Because people experience economies through grocery prices, rent, mortgages, insurance, debt payments, and housing affordability, not GDP charts. A person may technically earn more money today, but still feel worse off because inflation permanently rose living costs. Interest rates exploded, and debt became more expensive. That disconnect is why consumer sentiment has remained relatively weak despite resilient spending and strong asset markets. The wealth effect is quietly holding up the economy. This is one of the biggest under-discussed dynamics. When stocks rise, retirement accounts grow, and home prices increase, people psychologically feel wealthier. That's called the wealth effect, even if consumers complain about inflation. Seeing higher 401ks, bigger brokerage accounts, rising home equity helps maintain confidence in spending behavior. This matters because the U.S. economy is heavily consumption-driven. If people keep spending, businesses keep earning, layoffs stay lower, and GDP remains stable, asset prices themselves become economic support. Passive investing changed market structure. Now we get into the deeper layer. Over the last 2 decades, trillions of dollars flowed into passive investing through index funds, ETFs, which are exchange traded funds, retirement accounts, and automatic allocations. Funds tracking the S&P 500 and the NASDAQ 100 receive constant inflows from 401ks, pensions, institutions, and retail investors. The important part, most passive funds buy stocks automatically based on market capitalization, meaning the bigger companies become, the more capital they receive. That creates a self-reinforcing cycle. The reflexive loop. This is where everything connects. Step 1, you have money flows into passive funds. Step 2, passive funds buy index-heavy companies automatically. Step 3, large cap stocks rise. Step 4, household wealth increases through retirement accounts, brokerage accounts, and pension exposure. Step 5, consumers feel wealthier. Step 6, consumers continue spending despite inflation pressures. Step 7, economic data remains resilient. Step 8, markets interpret resilience as bullish. And step 9, more money flows into passive investing, and the cycle repeats. Why critics call it a passive investing bubble? Some analysts believe markets have become increasingly dependent on continuous inflows, passive allocations, and liquidity momentum. The concern is not just valuation, it's structural dependence. Critics argue price discovery becomes weaker when massive amounts of money buy assets automatically regardless of valuation. In other words, money isn't always asking, is this company worth this price? It's often just flowing mechanically into indexes. That could potentially inflate mega cap valuations, concentrate market leadership, and disconnect prices from fundamentals, especially when passive inflows remain strong. Why this connects directly to consumer sentiment. This is the key insight. Modern consumer confidence is increasingly tied to asset prices. People may say inflation is terrible, housing is unaffordable, and debt is crushing consumers. But as long as portfolios rise, retirement balances grow, and markets stay elevated, the negative sentiment doesn't fully translate into economic collapse. Asset inflation partially offsets economic pain psychologically. That's why consumers can feel stressed yet continue spending while markets remain strong. The danger of the reverse cycle, or the flip side to this conversation. The concern is what happens if the cycle flips. If layoffs rise, spending slows, recession fears increase, passive inflows weaken, or stop, or markets fall sharply, the wealth effect can reverse. Then consumers feel poor, sentiment weakens further, spending contracts, earnings decline, and markets face more pressure. That creates a negative feedback loop. The same system supporting markets on the way up can amplify weakness on the way down. So that also goes into where if passive inflows weaken and more retirees, they didn't throw that in here, we didn't throw that in here, more retirees start withdrawing more money out of their retirement accounts, that can also amplify that weakness and pressure on the way down and cause the market to crash, so to speak. The bigger picture, this is no longer just a fundamentals driven economy. It's a system increasingly driven by psychology, financialization, liquidity, asset appreciation, and passive capital flows. Consumer sentiment affects spending. Spending affects earnings. Earnings affect markets. Markets affect household wealth. Household wealth affects confidence. Confidence affects spending again. Everything is connected. Everything is a loop. Modern economies don't just run on production anymore. They run on confidence, liquidity, and asset prices. Consumer sentiment, passive investing, and market performance are all feeding into each other through one massive psychological and financial feedback loop. And the real question is, what happens if that loop ever reverses? Peace.